And hello once again, options traders. Well, this is really going to be the first of a two-part series. And this first one I'm calling The Bend is Your Friend, and it's going to be followed up with another video, the one coming up next, called Why Pay for Time. And that's really the more important part of these two videos. But in order to talk about that and why you should pay for time, you have to understand about the bend is your friend. Now, normally in technical analysis, we hear the trend is your friend. So what am I talking about here when I say the bend is your friend? Well, I'm talking about that bend that you get in a risk graph that I point out in every single video whenever we talk about a risk graph. So why is that something that you should be recognizing is beneficial? Well, let's go find out. And before we do, as always, please be sure to click like and subscribe. It's definitely appreciated and making a very big difference in promoting the channel. So the main thing that you have to understand as an options trader, as an options buyer, is that it is giving you the right to walk away. Now, sometimes they'll usually say, well, you have the right to exercise and enter into the long position, let's say, to buy it with a call option, or enter into a short position with a put option. And that's certainly one way of looking at it, but we can also look at it from the other perspective. It's giving you the right to not exercise. It's giving you the right to say, I don't want to exercise this call and buy those shares. And that's a powerful thing. So always remember that long options have the right, not the obligation, to exercise, or in other words, it is your right to walk away. And that is critically important, and I find that so many new traders completely miss this point. And it's this right that creates the bend in the risk graphs. So for example, let's take a look at long shares of stock. And we've seen this many times, just a straight line, 45-degree angle. We get our crossing point here at 0. That's our break-even point. So if we just bought the shares for 100, that would be our break-even point. But we have delta 100. And what this means is that if you have 100 shares, that every time the stock rises $1, you're going to make $100. But if it falls $1, you're going to lose $100. We could also look at it from a different perspective. If the stock rises $1, that you make 100% of that dollar with the shares of stock. So that's another way of understanding what delta 1 or delta 100 means. Now, of course, if we can buy shares of stock, we can also short them. We're going to get the kind of the opposite here of the risk graphs. It's going to lean to the left. It's what we call a negative slope, and for 100 shares would be minus 100 deltas. But notice that they are symmetrical. It's just like looking in a mirror. The right half exactly offsets the left. So if you were to buy 100 shares of a stock in your account and also short 100 shares in your account, what's going to happen? Well, we can see that every single dollar out here where you're making money, on the green part, that's the long position, is exactly offset by the red part, by the short position. The same is true if the stock falls. All of the gains that you would make with the short position are exactly offset by the long position. So again, if you bought the shares and shorted the shares, which you're not actually allowed to do in the same account, but if you were allowed to do that, that's just effectively selling them. You've got no deltas. It's just a flat position. But this is not what happens when you are dealing with options. So for example, let's go back to our shares of stock, but now let's overlay it with a $100 put. So here is the risk graph for the $100 put, and there is the bend that I always talk about. It lines up right at our strike. So if we just bought the 100 put, this is where the bend occurs and will always occur. But notice that if the stock in fact falls, which is what we'd like it to do if we buy the put outright, we have negative 100 deltas, just as if we shorted shares of stock. But that's not true to the right. See, to the right, we're flat over here. We have 0 deltas. We're not really harmed by rising prices. Yes, we could lose what we paid for the put, but we don't go into unlimited losses like we would if we shorted the shares. But take a look to the left. Do you see these negative deltas out here combined with the positive deltas of the shares of stock? They are offsetting each other. So if we buy the put and we buy the stock, if the stock price falls, we are eliminating all of these gains because the long position would be taking losses. Or conversely, if the long position is taking losses, the short position is making gains. So we're offsetting both of these portions of that risk graph. And that's because these are 45-degree lines here. They exactly offset each other. But look to the right, that's not true. Over to the right, we still have our positive 100 deltas, but they're combined with 0 deltas. So that means if we blend these two, we should see positive 100 deltas to the right of 100 and flat to the left. So let's do that, and there we go. It's a call option. So you can see that, which I've pointed out before, that if you buy a put, don't think of it as a put. It's really more of an option. We could just buy shares and turn it into a call. We can always change the deltas with shares of stock. It's the bend that is what you're paying for. It's the ability to have 0 deltas to one side of the risk graph or the other. So again, it doesn't really matter, because we could also do this. We could start with short 100 shares of stock, and we could buy the $100 call. Notice that we get 100 deltas out here to the right if the stock price rises, but to the left we have 0. It's just the opposite. So everything to the right over here is offset by these losses down here from the short stock position, but over to the left that's not true. We always have negative 100 deltas here from our short stock position, but we get 0 deltas from the long call. And so on a net basis, we will still have negative 100 deltas if the stock price falls, but we flatten out here to the right. So if we were to combine these two positions, that is short shares of stock and a long $100 call, we would get this. We would get the $100 put. So once again, we've talked about this before. Calls are puts, puts are calls. It doesn't really matter which one you're trading, because we can always delta hedge it to flip the direction. And the reason is because of this bend. And this is what you're paying for with the option. So always remember that the bend is the option. The bend comes from the right to walk away from the deal and say, yes, I can exercise if it's favorable to me, if the option has moved in the money, or I could walk away if it's moved to the opposite side. And so what you're doing when you are paying for an option, whether it's a call or a put, you are paying for time. And that is what's creating that bend. And this is the part that so many traders miss. You're not paying for the directional component and saying, I want to buy a call because I think the stock is going up. You're paying for the time, because we could buy a put and we could also buy the shares and have a call. Or we could short the shares and buy the call and have a put. So the option isn't so much about the direction, it's about the fact that you're paying for time. And again, you only get this from options. You don't get this benefit from shares of stock. You don't get it from futures. You don't get it from anything else but an option. But we're going to find out in the next video that traders easily overlook this. And it's usually because of fear of losses and risk aversion. But I want to show you some interesting insights about options pricing that will help you to make better decisions, and why, all things being equal, it's usually a really good idea to buy yourself extra time. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.